Theory number 1, the commodity theory. This is the oldest idea. Money is valuable because it's made of something valuable. Gold, silver, shells, even cigarettes in prisons. Here's the logic. If money is just paper, why can't we print infinite amounts? Commodity theorists say we can't because real money must be backed by something scarce. This is why gold bugs exist. They believe fiat currency is fake money. Theory 2, medalist theory, also called state theory. This says money gets its value from the government's stamp of approval. The king declares this is money, and boom, it's money. Why does this work? Because the government forces you to pay taxes in their currency. You need dollars to pay the IRS, so dollars have value. It's not about gold or intrinsic worth, it's about legal power. Critics say this is circular reasoning. Money has value because the government says so, and the government has power because it controls money. But look at any collapsed currency, Venezuela, Zimbabwe. The government said their money had value, but nobody believed them. Theory 3, the quantity theory. This is the big one that drives central bank policy. The formula is simple. MV equals PQ, money supply times velocity equals price level times quantity of goods. If you double the money supply without doubling production, prices double. That's inflation. Milton Friedman made this famous. Inflation is always and everywhere a monetary phenomenon. Print more money, get more inflation. Simple, right? Except, Japan printed trillions in the 2000s and got deflation instead. The US printed $4 trillion after 2008, and inflation stayed low for a decade. The theory works until it doesn't. Why? Because velocity collapsed. People hoarded cash instead of spending it. Theory 4, credit theory. This flips everything upside down. It says money isn't a thing, it's a relationship. Every dollar is someone's asset and someone else's debt. When banks make loans, they create money out of thin air. Your mortgage doesn't come from someone else's savings. It's literally invented when you sign the papers. This explains why 97% of money is digital, not physical. It's all just accounting entries. The economy runs on promises, not gold or paper. The scary part? If everyone tried to withdraw their money at once, banks would collapse. Because the money doesn't physically exist. It's all credit, all the way down. Theory 5, chartalism, now called modern monetary theory or MMT. This is the most controversial theory today. MMT says governments that print their own currency can never run out of money. Deficits don't matter. The government can always print more. The only limit is inflation. Sounds insane? Here's their logic. Taxes don't fund spending. They destroy money to control inflation. Spending creates money. The government spends first, then taxes to prevent overheating. Critics call this economic suicide. Supporters say we've been doing it for decades without realizing it. Who's right? We're about to find out, because governments printed unprecedented amounts during COVID, and now inflation is back. Theory 6, Austrian theory. These economists hate central banks. They say money should emerge naturally from the market, not be controlled by governments. Bitcoin enthusiasts love this theory. Let the market decide what money is. The Austrian view: central banks create boom-bust cycles by manipulating interest rates. Artificially cheap money causes malinvestment. People build things nobody wants because borrowing is too easy. Then comes the crash. Their solution? End the Fed. Let money be scarce. Let interest rates float naturally. And let bad businesses fail. No bailouts. No money printing. No manipulation. The problem? Every time we've tried this, depressions lasted years. The 1930s proved that doing nothing makes things worse. Or did it prove we should have done nothing harder? Theory 7. Sociological theory. This says money is whatever society agrees it is. Pure collective belief. Money works because we all believe it works. The dollar has value because your neighbor accepts it, and they accept it because their neighbor does. It's a shared hallucination that runs the world. This explains why crypto can have value. If enough people believe in Bitcoin, it becomes real money. It also explains why currencies collapse. Once belief breaks, the money becomes worthless overnight. The implication is wild. Money is a social technology, not an economic one. It's closer to language than to gold. And just like language evolves, money is whatever we collectively decide it should be. Theory 8. Monetary circuit theory. This is where money gets trippy. Money doesn't exist until someone borrows it. When you get approved for a car loan, the bank doesn't move money from someone else's account. They create it by typing numbers into a computer. Poof, new money. Here's the circuit. Banks lend to businesses. Businesses pay workers. Workers buy stuff. Money flows back to businesses. Businesses repay loans. Money disappears. That's right. When debt gets paid off, money gets destroyed. The entire economy runs on a continuous loop of money popping in and out of existence. If everyone paid off their debts tomorrow, 97% of all money would vanish into thin air. Theory 9. Fiscal theory of the price level. This theory says central banks are lying to you. Everyone thinks the Federal Reserve controls inflation by raising interest rates. FTPL says that's backwards. Government spending controls inflation, not the Fed. Here's why. Money is a government IOU. Its value depends on whether people believe future taxes can cover government debts. If deficits explode and nobody believes taxes will ever pay them off, money becomes worthless. That's inflation. This explains why Japan can print trillions without inflation, while Venezuela collapses. It's about fiscal credibility, not money supply. Raising interest rates won't stop inflation if the government keeps spending like crazy. Theory 10. Functional finance. This is the most brutally pragmatic theory. Economist Abba Lerner said, "Stop obsessing over balanced budgets. Stop freaking out about debt. Ask one question. Does government spending create full employment without inflation? If unemployment is high, spend more. Deficits don't matter. If inflation rises, tax more to cool demand. The government budget isn't a household budget. It's a steering wheel for the economy." Lerner literally said, "Worrying about deficits is like refusing to steer your car because you're afraid of wearing out the steering wheel." The goal isn't a balanced budget. It's a balanced economy. Critics say this leads to Venezuela. Supporters say we already do this. We just lie about it.